Hello. Well, certainly the bid in global equities continues in earnest. European markets were fairly flat, although they did overlook what was really going on in Greece. If you look at Greek yields, they spiked up quite sharply. I think the 3-year at the front end was up 385 basis points, or 3.85% at one stage. But actually we did see some buying coming back into the market as the session wore on. You know, I think it's really interesting just to see what the ECB are doing in terms of getting political. They clearly don't feel very compelled, or they certainly look very agitated about lending money to the Greek banking system ahead of these key negotiations, which originally, were scheduled for February 28th. They've moved them forward so that the banks will only be able to get liquidity from the Greek central bank from around February the 11th. And I think it just shows the unease that they have lending to the Greek banks ahead of this clear negotiational period that we've got coming through. But overall, we did see markets overlooking the Greek situation. If you look at euro dollar, it's had moved fairly rapidly, pushing up to the 115 handle. There has been talk that the European Commission have increased their growth forecast for this year and into 2016 as well. Of course, that's positive for a market that has been very short of euros. There's been talk as well that the Swiss National Bank have been coming in and actually buying euros to prop up Euro Swiss as well. We have to see how those sort of rumours transcend. And I think as well we've started to see the German bond market moving slightly higher as well, although US Treasuries did as well, which that spread hasn't widened too much. But certainly euro dollar up that 115 level. Be interesting to see if we can see markets coming in and looking to reapply shorts over the short term, because the Greek dramas are still very much unfolding. But I think we are seeing a period of instability in the US dollar. We've got the non-farm payrolls tonight. That could be very interesting as well. Of course, the market's going to be keying off the headline numbers in terms of job creation. We're looking for, or certainly the consensus is 230,000. I think probably the more important metric for me is obviously the unemployment rate, the U6 unemployment rate, which has been trending markedly lower since 2009, 2010. But I think most important is what happens with wages. If you recall, back in December we saw a terrible print where on the month we actually saw wages coming down on an annualised basis 1.7%. The Fed, for example, want to see that moving into a 3 to 4% range before they start raising the funds rate. Warren Buffett coming out last night saying that he sees absolutely no reason why they should be raising rates at the moment, and I think that's probably fair given what we've seen from inflation and certainly from wages. So I think the wages side of things is probably the more important metric there in terms of people who are watching the Federal Reserve very closely. And I think if we see some strength coming through, if we see the wages moving into sort of that 2% range again, then I think perhaps the dollar can get some stability as well. I think as well, as we stay in the currency market, it's interesting to see that the Aussie dollar against the greenback is actually higher now than when the RBA actually cut rates, which surprised quite a lot of people in the market. We've even got the credit markets or the swap markets pricing at about a 32% chance that we get a back-to-back cut in March. It's not my base case personally, but even this, and we've still got the Australian dollar higher. So I think it shows that we are seeing a bit of consolidation in the greenback. Part of that is down to the fact that we are seeing the price of crude moving higher again. The volatility in crude continues to be absolutely unbelievable to see. In fact, if you look at options implied volatility, it's the highest since early 2009. I don't think that's going to surprise too many people, given we are seeing intraday swings of 5% quite easily. But certainly the non-farm payroll is going to be very much in focus. US markets continue to push higher. I wouldn't be surprised to see a new all-time high coming through in the next few sessions. Perhaps a strong non-farm payrolls number with a fairly weak or benign wage increase could probably push the markets through that recent, the all-time high just below that 3,000 level. Here in Australia today, we are keying off that stronger S&P level. The index there was up 1%, and I think that's going to be reverberated quite nicely in our market. We're looking for a 30-point increase to the gains today, so we're going to be up for the 12th, maybe even 13th session in a row. Yield plays, no reason why you should see any kind of major weakness there. But our market has actually pushed up over 10% since that pivot or swing low that we saw on the 16th of January. That's moved up nicely. We've seen sectors like the material sector up 12.9% in that time, financials up 11%, energy doing quite nicely up 8.7%. There's some structural leaders that are coming through. Of course, the banks are ones that everyone's been talking about. You have to be buying dips in that space at the moment. Whilst yields are coming down in the bond market, whilst there's a perception that we are going to see further rate cuts, you've got to be in those yield stocks. You've got to be in any kind of stocks that's giving you that income and returning cash to shareholders as well, is another mantra that we've been looking at as well. We've also got a key decision in terms of what's happening in the statement of monetary policy today. The RBA will be giving their views on the outlook and their economic projections. If you look at the key one, which is inflation for probably mid this year, They're looking for a range of 1.5 to 2.5%. You know, given the fact that Brent prices have been forecast at $86 and they're trading closer to 50 at the moment, you know, it will be interesting to see what they tamper around with their inflation forecast and justify why they cut rates by 25 basis points at the February meeting there. So a lot to look out for in our session. Of course, China's flying at the moment. Be interesting to see if we can see, you know, better flows towards that sector given the reserve ratio cut that we saw in the prior session and just the liquidity measurements that are going through there. But certainly the Australian dollar looking very, very weak against the pound at the moment. That's probably, if you're going to look to short the Aussie, that's probably your currency of choice at the moment. But against the greenback, I certainly wouldn't be looking to go short Aussie against the greenback at the moment. I'd probably be looking for a little bit more of a squeeze up to that 78.82, which is the 38% retracement of the recent sell-off. And I think that's probably a better place at the moment to be looking to sell into these while there's a few uncertainties and people looking to buy the dips, and there's been good support there. So looking to sell rallies, but it probably wouldn't be right now. I'll be waiting for a little bit of a move up and then looking to reapply shorts there.